Live stream party. What is going on in the markets? Let's see, any big news that popped up today? I'm going to check Yahoo Finance. No. What are the big stories? What are the big stories? Futures climb as Nvidia jumps ahead of rate meeting kickoff. Oh boy, there we go. Yeah, it's Nvidia and the Fed. Interesting. PepsiCo plans layoffs as it looks to wrap up Elliott talks. Interesting. Wow, Ed Yardeni sees a roaring 20s bull market continuing. I'm going to open this up. This one's pretty interesting because this guy's not really like a huge bull. He's an economist. Let's see, where is it? Boom. Okay. Roaring 2020s will continue in the year ahead. He wrote a note to clients that he expects S&P 500 to reach 7,700 by the end of the year. That's interesting. Where are we at now? I thought we were at like 68 or something. End of the year. I mean, we got 4 weeks left. Dang. 68.46. It's a pretty bold prediction there. That's the base case scenario. 2026, raising our subjective odds of this prospect from 50 to 60%. Less concern about a melt up or meltdown scenario. Interesting. Lowering the odds of that from 30% to 20%. Keeping bearish scenario at 20%. Okay, I want to hear why, Ed. Yardeni's forecast assumes earnings and the economy remain resilient and adds to this year's list of stock market outlooks, which have taken on a generally bullish tone. Yardeni sees earnings growth powering stock prices, thank God. We expect S&P 500 companies' collective earnings per share will increase from 268 to 310. Wow. Expects economic growth to accelerate in 2026, citing Trump's focus on the affordability crisis, tax benefits, baby boomers reaching retirement, monetary stimulus driven by a Fed rate cut, AI-driven tech boom. Wow. Okay. That's interesting. Well, he's ending his 15-year overweight recommendation for tech stocks. He no longer recommends investors hold more of these sectors than the index weight. Oh, okay. So previously he was overweight. That's interesting. Ed with a little surprise there, a little shocker. Okay. That's interesting. Interesting take there, Ed. Interesting take. Let's see what's going on in the chat. Hey, Cooper. Barbarians at the gate. Yes. Yeah, it's pretty wild, this back and forth. There are definite like antitrust concerns that I think are going to come into play. We're referring to the whole Warner Brothers, Paramount, Netflix back and forth. And it's kind of interesting because like the actual properties that they have are not like really kind of like platinum properties, so to speak. But it'll be interesting to see how it all shakes out with that deal. I heard the new offer includes an extra 18 billion in cash. I mean, that's pretty remarkable. That's a lot. That's a big swing. So it'll be interesting to see how it all shakes out. I mean, it's definitely gonna get done one way or the other. But this is pretty cool because it's been a while since we've seen something like that happen, where you have kind of a back and forth between two bidders on an asset. I got some new water this week. I don't know. You've probably seen it at the grocery store, perhaps. Eternal. It's alkaline, naturally alkaline spring water, even though water's neutral, but whatever. Pratyush, I'm doing well, my friend. I hope the same for you. I feel like it's fair to not overweight tech compared to the index since tech is such a huge weight already. Yeah, I mean, it seems kind of odd that he was I mean, look, good call, dude. advising being overweight in tech the last 15 years when, to your point, the S&P 500 is 33% tech. So you're already like got an overweight in tech. So kind of interesting. But then you see all these like stats that they come up with where they'll say something like if you excluded the Mag 7 from the S&P 500, like the remaining companies, their performance is basically like neutral, if not negative. It's pretty crazy. But interesting conversation with AI bubble, tech, all of that stuff. The interesting thing there is that when you really think about it, if it were a bubble, you wouldn't see the fundamentals increasing as the stock price increased. You would just see the stock price increase without the corresponding fundamentals. But the interesting thing is, this past week we looked at Amazon. Prior to that, we looked at Meta. Like the actual underlying fundamentals are improving. So that's the thing that's kind of bizarre when people are like, AI bubble. It's like, okay, like show me why. The fundamentals are actually improving across the board. So that's something that you have to really kind of double click on. It was funny to watch all the bankers posting on LinkedIn as it was a done deal. Yeah, no, not yet. It'll be interesting to see how it plays out. It'll be a good like lesson for everybody to actually like watch it in real time. I mean, tech is where money is, and it's not all of it is overpriced. I agree. I mentioned this previously. Right now, in terms of the Mag 7, I would say the best values are, ironically, what we just covered, Amazon and Meta, those two. And then also Microsoft. That's one I'm in the process of digging into right now. I still think they're going to be the big winner in the whole AI arms race. I would say, Tesla overvalued, Apple overvalued, Nvidia overvalued. I still can't figure out Apple, to be quite honest. Like they don't really seem to have an AI plan, but everybody's like, "Oh, don't worry, it doesn't matter." It's like, okay, I don't know what their ultimate plan is, but hey, rock and roll, man, rock and roll, let it rip. But yeah, that's the whole thing. When people are like, "Oh, tech," and they're like anti, tech stocks. It's like if you look at the recent pullback in Amazon, the recent pullback in Meta, you could have argued like previously, like, hey, they're a little bit frothy. Like, oh, Google's the other one, Google Alphabet. That's definitely overvalued. But you do have tremendous value still between Amazon, Meta, and Microsoft. So those three to be able to get. But whenever you look at it and you see these pullbacks, like they don't last forever. I mean, it's crazy to think this, but when we covered Nvidia the last time on the channel, it was in, I think, April, and it was at $97 a share. So I was like, yeah, no brainer. It's a buy. I think the value was like 134 that I had on it. But then once it went past that, and it went past the bull case value was like 156. It's like, okay, now we're starting to get into like crazy territory. Once you start talking about like 200 plus, it's like way far ahead of itself. The other one that's interesting, and I'm curious to see where it's at. I didn't look at it today. Oracle. That one came like crashing back down to earth. Remember they had the big OpenAI announcement. The stock went like over 330. I'm looking right now, 52-week high, 345.72, 345.72, and it's back down to 220, which is pretty wild. On the year, it's up 15.8%. But that one I haven't dug into. That one would be an interesting one to take a look at as well. Ooh, good question. Hey, Ken, do you have any advice on how to find and pitch a short? So my advice always with a short is there needs to be some sort of catalyst. So, for example, if a company has announced like a big contract and like something goes sideways with the contract, and that contract's going to be like a huge amount of future revenue for the company, that's an obvious short. Accounting irregularities, obvious short. So, super microcomputer being one that we've covered previously, Hindenburg Research, they did this like really, really amazingly comprehensive analysis on, and I would say like if you want a good example, go to that. Just type in Hindenburg Research, super micro. And when you go through that, it's like, oh my gosh. Now, the funny thing is, if you look at some of like the trolls in the comments from the previous Super Micro video, it's like Hindenburg Research went out of business. It's like, okay, does that invalidate the thesis? You know, if you're living on like a short mindset, especially like when you're fighting against the market momentum, that is very difficult. That is very difficult. So I would say if it's lacking in fundamentals, that's an obvious one. You know, I would say GameStop, when everything was going on during COVID, I mean, that thing was just like insane. I was looking at like long dated puts for that one specifically, and they were still pretty expensive. So that would be an example where it's like everybody knows this thing's overvalued. It's like not a question. Like everybody agrees, yeah, this thing's totally overvalued. But goes back to John Maynard Keynes, the market can remain irrational for longer than you can remain solvent. So the only times I've really gone on the short are when it's like the business is not going to be able to make it. That's another example. So if the company is coming up against like a debt wall and they're not going to be able to refinance it, or they're about to blow through their covenants, those are the types of things that you'd want to be looking at. Obviously, being overvalued is a huge piece of the puzzle as well. But those would be my pieces of advice. But I would say like a good example to look at Hindenburg Research, their thesis on Supermicro, and that thing is like a master class. And they just go through a lot of accounting irregularities, a lot of like head scratching, you know, related company relationships, things like that. Those are the types of things that you're like, something doesn't really add up here. That's the type of stuff that you want to look at. But just because like a stock has gone up doesn't mean it's going to just like come down. You know, when stocks are overvalued, like even when we did the Tesla video a few weeks ago, I said Tesla's overvalued. I'm not beating around the bush here. But I still felt like if you hold Tesla, you could trim it, but I wouldn't just dump it. That's why a lot of times with Wall Street equity research, you'll see the rating won't be sell, it'll be underperform. So underperform basically means like, hey, just a heads up, this is going to underperform the peers, the market, etc. So that's the type of stuff that you want to look at. Yeah. So this is so incredibly true. Amazon is a very frustrating stock to own. I totally agree. It's one of those ones that just is like you see the value, you know it's undervalued, and you're like, all right, here we go. And it doesn't pop the way that like the other Mag 7 tends to. So yes, I totally agree. I totally feel your pain. It's one of those ones where it's just kind of like slowly but surely going up and to the right, but it has these like downdrafts. When it has those downdrafts, that's where you buy more. You don't just buy for the sake of buying. So when it hit the 52-week high, 258.60, and then comes down, goes down to like 220, it's like, okay, it's undervalued. You take some nibbles at it. But yeah, that's a frustrating stock to own. Not sure if you own PayPal, but that's another frustrating stock to own as well. Uh, Heard Apple AI to be coming in 2026. Okay. I mean, they're going to really need to blow it out because the market's kind of like, what are you guys doing? And they really haven't had a valid answer. Pretty underwhelming. Okay, here we go. Apple's AI plan is to just use Gemini. Interesting. And take money from Google to be the preferred AI for all iPhones. It's not a bad play. Same way they got paid to use Chrome. Ah. But the only thing with that was I'm almost positive there was a ruling against that they couldn't make it the default. I know that they had to each pay a fine for that because it was viewed as anti-competitive, but that's interesting. Just piggyback off it. I shorted Starbucks due to the overpricing of their CEO and what I believe were fundamentally flawed views of the coffee market. They're dumping money into the exact wrong strategy. Yes, and I also agree with that. Short. Hold on. Focusing on dine-in instead of drive-through and dumping a stupid amount of money into renovations. I felt it was ripe for a short. Yep. I mean, there you go. I think also when there's transition and there's not a high level of confidence in like leadership, that's the type of stuff. I mean, they brought on a new CEO. I think they lasted like 18 months or so, and then they dumped it and got the Chipotle dude. Um, yes, can you speak on what you think Amazon has been lagging behind as of late, and if you think they will outperform moving forward? Yeah, so I think it's definitely undervalued as per the video. I think it will do well on a going forward basis. It just doesn't have the volatility of a lot of the other Mag 7 stocks, which isn't necessarily a bad thing. I think the bias towards Amazon is when you think of Amazon, you think, oh, this is a physical product company, but their advertising is really the hidden gem. It's crazy to think that they didn't have any advertising until 2019. It was like 12 billion in 2019, and now LTM it's 65 billion. That is the interesting thing. So I think people are kind of missing that. Also, you had I think a lot of people, and obviously the thumbnails that we do, like a lot of people still think like Amazon Jeff Bezos. They don't really associate it with Andy Jassy. Andy Jassy is a very different CEO than Jeff Bezos. Jeff Bezos would basically try to throw spaghetti at the wall for all intents and purposes. I know that's not like a technical corporate finance term, but Jeff Bezos would take shots at different ideas and investments. If they worked out, great. If they didn't, that's fine. Like they tried to do some phone related stuff as well. And then it's like, yeah, this probably doesn't make sense. Andy Jassy is a lot more methodical in terms of capital allocation. I don't think they're going to do anything to like wow people. Online and physical stores is still like 40% of their overall revenues. Third party resellers, basically the people that sell on Amazon, that's another like 23%. But really, where the growth is advertising and AWS. Those two areas are like the no brainers. And if you think about it, if the company is primarily like eventually more of an advertising AWS focus, that's where it could get very interesting. And that's where you would see kind of that more rapid growth. But they can't get away from the physical product piece. Also, there's a big question as to like the optimization of delivery. Also, right now, firing a lot of layoffs. While that's controversial, the layoffs are basically in the distribution centers so that they could replace those folks with robotics. And it's like very controversial. Like, how can you do this? Da 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 da. But it's kind of like, yeah, but this is the way that it's going. So, I mean, look, that's something where I would say, yes, a robot should be able to do that much more efficient in like the actual distribution centers, fulfillment of orders, stuff like that. But that's also a lot of what's going on. That's creating a lot of noise with Amazon. So until they kind of work through that, that's going to be a little bit of overhang on the stock. What are your thoughts on the PE value of Celsius? Does this impact your stance in any way? So we covered this previously. The reason why the PE is so high is because a one-time distributor termination cost of $246 million. So basically, Alani Nu had contracts with all of their distributors. Now they're going to enter the Pepsi distribution network. So they have this one-time expense that is causing the earnings to get crushed, and net, Pepsi's paying it. So it's like, does that change the thesis? No, it's a one-time non-recurring item. So no, it doesn't change it at all. But again, if you don't dig in and try to figure out why, it's like, oh my gosh, it's 313 times earnings. Like this is overvalued. It's like, yeah, but there's a one-time non-recurring, non-operating related cost that's causing that. So yeah, it doesn't change the thesis. All right, here. The ruling for Google and Apple is that they can't make a 10-year deal to use Chrome on iPhones. They can only do 1-year deals. So they just keep rolling it. Okay, that's interesting. That makes sense. Yeah, so I was like, all right, fine. We'll just do it every year for infinity. Getting back to Warner Brothers deal, which offer do you think is better? I think Netflix, but would love to hear your view. So all I did was I heard of the new offer that it was like 18 billion more cash. Let's pull it up so we could go through it. Warner Brothers. All right, so let's see. News. Yeah, because I haven't dug into. Okay, here we go. Whoever wins Warner Brothers. Okay, here we go. Perfect. Perfect. Oh, don't tell me it's just a video. Merp. I mean, we could play it. We could play it. Let's see. Ah, there's an ad. Merp. All right, it's 2:55. Let's do it. All right, hold on. They're gonna compare the two offers. Let's do this. This is actually pretty helpful. No, 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 no. All right, friends. Share screen. There we go. All right, I'll crank the volume.
Cash deal worth $30 a share. This comes after Netflix won the bidding war for Warner Brothers movie and streaming units. Joining me now is Geeta Raghunathan, of Bloomberg Intelligence senior media analyst. Geeta, just when we thought this thing was done, or maybe suspected it was done, we get another twist and turn in this. And we're learning some interesting things also about the financial backers for Paramount as part of this. But let's start with just where we are today. What do you think the outcome of all of this is going to be?
I mean, I don't know. It's anybody's guess. But the good thing, I think the winner is definitely Warner Brothers Discovery, because you have here two very, very interested bidders who are willing to go all out, Julie. I mean, we saw Netflix kind of make that deal for about $27.75 per share for just the studio part of it. Paramount, of course, coming in with $30 a share. Of course, this all rests on where Paramount is kind of valuing the TV networks unit, because remember, they are buying all of Warner Brothers Discovery, whereas Netflix is only going for the studio and streaming segment. And Paramount basically valuing the TV networks at about $1 a share. The street view is much higher, I would say, at about $3.50 a share. So that's where we're seeing a little bit of the delta. So I think the street still views the Netflix offer as the superior one, but Paramount really kind of promising regulatory certainty, speed of completion, and of course, as you brought up, the financing part as well, not to mention the fact that this is an all-cash bid.
The financing is interesting because apparently there are some sovereign wealth funds, financing partners from the Saudis, from the Qataris, the Emiratis, who have said in exchange for this, they are actually going to give up governance rights. So, you know, having a say in the deal and in the management of the company, maybe in exchange for some behind the scenes influence, if you will. How does that affect how people see the deal or the regulatory approval of the deal, or does it not?
I think it matters, and I think that's why Warner Brothers Discovery was concerned in the first place, because as you know, there was some reporting that that suggested that all of these sovereign wealth funds were involved, that maybe there was some Chinese money that's involved, and of course that is going to trigger a regulatory review. And I think that's one of the reasons why Warner Brothers Discovery was hesitant on proceeding with Paramount Skydance. Paramount Skydance, of course, rebutting and saying that the whole deal, the equity portion, is backstopped by the Ellison family as well as Redbird Capital, and that should give Warner Brothers Discovery enough confidence in terms of the financial portion of the deal.
All right, well, there you have it.
Granger knows that as
So interesting. I think there's going to be less regulatory challenge with the Paramount versus Netflix. I think that's really what it boils down to. But the shareholders are going to vote and decide. What'll be interesting to see is if it goes back and now they're like, well, we'll offer $30 a share. But it's not for the whole company, whereas Paramount's is for the whole company. Netflix is just for the studio. So That's interesting. How are you thinking about 2026? So it was interesting at the very, very beginning when we started out. Ed Yardeni is a famous economist, and he actually said, and I had to like do a double take. He has the S&P 500 at 7,700 at year end. We got like 3 weeks left, so that's a little aggressive. Um, I think 2026 will be better than people expect. So if you think about it, the whole new tax regulation, tax law, big beautiful bill, all of that is going to be like realized and recognized basically 2Q of 2026. So when people get more money back from their taxes, that should benefit the economy in 2Q of 2026. In addition, everything that's going on with the accelerated depreciation, that's going to impact a lot of companies with their 2025 filings. But again, that doesn't actually impact taxes until they, file their taxes, which would also be April 15th. So I would say 2026 2Q, and then the second half, that's when things should pick up substantially. You're going to see kind of like the flow through of all the tariffs, the tamping down of inflation, Fed lowering rates, and that helping investment. That is what I see for 2026. So I think 2026 will actually be fairly good. Fairly good. Do you have different levels of confidence in the different FAMA French risk premia? I love this. So the FAMA French model has proven to be effective and successful in predicting returns. I remember when I got my master's at Boston University, very big fan of the program, by the way, where we covered FAMA French and like actually did regressions on it. I would honestly have to go back and look at the different factors specifically to kind of give you like my take one by one. That being said, it does identify outperformance. The issue is some of the factors show more significance than others in different markets and at different time frames. So I haven't looked at it recently enough to say like, hey, this is the factor that I would be like really honing in on. So it definitely works. Like I have a lot of buddies who run hedge funds, and they use a FAMA French approach, and they weight factors accordingly. So yes, that is it's legit. It is legit, and it does actually work. How will Netflix move to acquire Warner Brothers and Paramount's competing bid affect Netflix's competitive position, growth outlook, and potential regulatory risk? That's a good question. I think the biggest challenge, honestly, is regulatory approval for the Netflix bid. I think the whole idea is the studio piece. So, ironically, here in Jersey, Netflix is doing this like massive build out in central Jersey, like somewhat near the shore. What they're trying to do is they're trying to create what they're kind of coining a Hollywood East in that area. So that'll be interesting to see if they're actually able to kind of like challenge Hollywood, especially with all the streaming. A movie that goes direct to streaming without entering the movie theaters. I mean, Warner Brothers is, obviously huge name when it comes to movie titles. So I think that's really their play is they're trying to become Hollywood East, and they're trying to leverage the brands, the relationships, etc., from Warner Brothers because they're just buying the studio. Whereas the alternate Paramount, they want the everything. They don't want just the studio. They want everything. So as a shareholder, I would, lean towards the Paramount because it has more chance of getting done. What we saw in the video that I shared is the kind of counterpoint to that is it appears like they're undervaluing the assets. Wall Street has it at $3 per channel. They have it at $1 per channel. But again, it doesn't mean they're going to accept this bid. My guess is either Netflix will come back with a competing bid, or they'll move forward with Paramount. That much is not 100% clear just yet. Just yet. Good question. How much would you allocate to a speculative type of position like Joby? I would say like max 5% of your portfolio. And the way that you have to think about it, if it goes to zero, 5% of your portfolio is not going to matter. If it goes to zero and you have like 10, 15, 20%, that's going to sting. That's going to really hurt. So with speculative plays like that, I would say 5% should be kind of a max weighting. Because here's the counterpoint. Let's say it goes with my thesis and at 100x. If it's 100x and you have a 1% position in your portfolio, it's not really going to have as much of an impact. That being said, in terms of your total portfolio speculative, I mean, we're all, collectively young here. So I would say if you were in like your 50s, 60s, I would have very little percentage of the overall portfolio as speculative, probably 5% of the total portfolio. But if you're anywhere between 20s to 40s, you can afford to do, up to like 15, 20% speculative. But again, like the way that we structure portfolios on Wall Street for folks is a core satellite approach. So what you're kind of referring to is like a satellite component. It's usually like 80-20, 90-10, with the core being that 80 to 90%. So the other thing too with speculative like ideas is they're typically not long term. So if you're investing in Joby like I am for the long term, it's either going to go to zero or it's going to like rip. I invested at like 4 and change, so at this point I'm happy, but massive volatility in that. And that's the other piece that you have to kind of watch out for. A lot of people can't handle the volatility aspect of it. I mean, like Joby is like a massive part of my portfolio going up or down on a daily basis because it's so volatile and it can go up like 5, 6, 7, 8% or down in one day. So like it like really like rockets the volatility on a day in day out basis. So that's what I would say, just high level without knowing a lot more information. But again, it's a function of risk tolerance. So if it went to zero, would you be okay? I wouldn't be happy if Joby went to zero, but it wouldn't really impact my life because it's 5% of the portfolio. That's the key. What's your take on the next CEO of Apple and Satya Nadella's compensation package? So did they actually select the next CEO of Apple yet? I know there were a couple people that they were honing in on. Let's see. Next CEO of Apple. Yeah, this is the guy. John Temis, Senior VP of Hardware Engineering, widely considered leading internal candidate. I mean, look, when it comes to a company like Apple, Warren Buffett has a great saying, find a business that is so simple that even an idiot could run it because eventually one will. Apple's kind of one of those. I don't want to make anybody think like, oh, it's easy to run a company like Apple. Not the case, but it's such a successful business with such a massive moat. I don't think it's going to have a massive impact in the grand scheme of things, this new guy, as long as they're conservative in their approach and they don't try to flip the table over or do anything like super aggressive. I think it's good to get some young blood in there. So it'll be interesting to see his take. But from what I've read, he's a pretty level-headed guy. As for Satya Nadella pay package, his total comp for 2025, $96.5 million, a record high. Package is primarily composed of performance-based stock awards, $84 million, $9.5 million cash bonus, base salary, only $2.5 million. So I'll share the screen so you guys can see this. Pretty wild. I forget, there was a guy a few years ago who had 300 million in 1 year, but it was mostly due to stock. But it's still real money. So 96.5. I mean, look, if you increase shareholder value, I personally don't mind. But I think that's a stock that has kind of been a little underwhelming. I called it a while ago, like, hey, this is a no-brainer. I mean, it went down 344.79. I was kind of surprised it went that low. Um, but 52-week high 555, currently 491. Um, I'm fine with that as an investor in Microsoft. I think he's doing a good job. So I personally have no particular issue with his pay package, but it's something you always have to keep an eye on. Honestly, like you want to make sure that they're actually increasing shareholder value and they're not just, kind of hanging out and, getting paid for a lack of performance. Um, Thoughts on the current value of ARM? I haven't looked at ARM in some time, but why don't we take a look? Let's pop it up on FinViz here, and I'll share my screen. ARM. Looks like it has pulled back a little bit, which is interesting. Let's see. All right, ARM. Come on. FinViz. All right, here we go. So about 140, give or take. Let's see. Target price 174. Okay. Significantly undervalued based on that. Here's the things that I'm like not super happy with. ROE 12.37. Return on invested capital 10.67. Gross margin phenomenal. Great job. Great job. But the returns are not like wow. So that's where I would kind of be a little bit hesitant. Let's see. Raymond James has them at market perform. Cowen has a buy. They moved their target up to 190. Another buy rating. I mean, look, the thing for me, I know it sounds crazy. I'm not a huge fan of semiconductors in general. It is a very cyclical business. And once all the AI madness ends in the next couple of years, what's going to happen to all of these companies? Right now they're riding the wave of a cyclical high, but I'm not a huge fan of semiconductors in general. They've been on an absolute like face ripping tear right now. But if you take AI out of the equation, that it's a very cyclical business. And that's the thing that I just don't really like about it. Right now it's like, oh, they're just going to be, going up and to the right forever. Not really. So there's specific pockets. I think the thing that's interesting about an NVIDIA is the idea that they're a designer of chips primarily. And I like that a lot better. But again, like once we get to 2028, what's going to happen with all these companies? That is kind of my question. And I don't know how well they're going to perform once that occurs. Therein lies the question with all these semiconductor companies. I mean, it really is like a race to the bottom from a business perspective. Very, very capital intensive. You need a lot of money to stay competitive in that business. So that is just something that, in general as a business, I just don't like. That being said, ARM looks like it's like 30% undervalued. So, if it's something that you own, you might want to nibble a little bit more. Do you think Meta will dip into the 500s again anytime soon, or are we starting to see the uptrend? I think we're definitely seeing the uptrend. I don't see it hitting the 500s. No, that was the whole tariff craziness. That I don't see we're gonna be at the 500 unless something crazy happens where like Mark Zuckerberg is like, hey, we're going even harder into the metaverse, and even though it's losing, billions and billions, we're going to go even harder into it. Remember, 98% of the revenues for Meta come from advertising. So it's a very, very like high margin, wide moat business. So it's one of these companies, like I mentioned earlier, if you can get it at a discount, you take advantage. But the discounts typically don't last that long. I mean, I didn't see where it closed at today, but I saw since we did our video, it's been on an upward trend. Yeah, 666.80. That's not a good number. 666. Basically 667. You know, so it's already up since we did the video. Obviously, I'm not insinuating it's up because of our video, but it usually doesn't stay down for too long. Hi Ken, your Celsius video brought me to your channel and bought 1300 of Celsius, and I'm 15. All right, cool, and really like your video analysis. Awesome, good stuff. What do you think of UNH as my biggest holding? So first off, as someone who's 15, I will literally give you advice. If you follow it, it will make you a guaranteed multi-millionaire. Because when I do this for folks and I talk about 401k and IRA, and I'm talking about people that just started their jobs on Wall Street at like 21, when you run the numbers based on the historical performance of the S&P 500, 10.4% over the last 70 years, you end up with like $15 million if you max your IRA and your 401k without even accounting for the employer-employee match. Now, if all you did was you said, you know what, I'm going to dollar cost average into the S&P 500, VOO, okay? So that's the Vanguard S&P 500 Total Return Fund. You will have millions and millions and millions and millions of dollars. Now, again, the whole channel, if all I did on the channel was like, hey, dollar cost average in the S&P 500, have a nice day, no one would come to the channel, obviously. So the stock component, like when I talk about stocks, the assumption is you already have a core foundational holding in VOO, S&P 500. So like, for example, me, my 401k from Rutgers, S&P 500, VOO, boom, okay. My IRA, S&P 500, VOO. Whatever's outside of that, above that, that's where I'm investing in individual stocks. So what I would say is instead of going deeper into individual names, start allocating towards VOO. All right, you're getting the benefit of the entire S&P 500, massive diversification. That is like the biggest no-brainer. Now the problem is when you tell people that, they say, well, what about Nvidia? It's like, yeah, you could invest more in Nvidia, go right ahead, but again, like 98% of professional money managers, Wall Street, 98% underperform the market. The market is measured by the S&P 500. 98% underperform over the long term. So you're going to take a 2% chance that you're going to be able to beat it, or just can't beat them, join them, like just boom, invest in it. And then above and beyond that, that's where you go into individual names. As for United Healthcare, I've stated this a bunch of other times on the channel. You have to be like really careful. That business, yes, got kicked in the teeth. Yes, Berkshire Hathaway. Yep, all that stuff. It's just a horrible business. You're a price taker, meaning you don't set the rates. You're basically given, these are the rates you're charging. It's a highly regulated business. It's a very low margin business. So if you said, hey, what's like a business that I should get into? Like one of the last ones that I would ever answer would be health insurance. And that's what they engage in. So I'm just not a big fan. That being said, like if you're going to hold it for the long term, you're going to be fine. And it's the same thing with Celsius. Celsius is undervalued. I've been buying more myself. You know, Alani Nu comes into the Pepsi distribution network. That's just going to open up a whole other opportunity set for them. And I see, you know, big upside there. I see Alani Nu everywhere. Previously, I didn't really see it as much. So you can see it's already taking hold. But yes, definitely 100% VOO, VOO, VOO. Do you like Boston University? No, I love Boston University. I had a great experience there. It is a really great program that they have. You could go to Questrom, which is their business school. They also have a lot of really, really good online programs. that would be something I would definitely look into. Very well regarded, great faculty. I've taught a bunch of classes there as well. Definitely really, really, really solid program. Like I'm huge fan, huge fan. Definitely great school, 100%. Hey Ken, do you have any thoughts on the cybersecurity industry? Yes, I do. I've been taking a look at Fortinet as it's mostly been a laggard. I apologize. I think you're probably the one that commented, like, what do you think about Fortinet? Um, so I have a pretty sizable investment in CrowdStrike. So I am a huge fan. I picked out CrowdStrike when there was the Microsoft outage, which is crazy. It seems like it was yesterday. It was last summer, 2024. The stock went down to like 220, and you could go back on the channel and see the video I did. I think I had the video was when it was at like 240. So I did like two videos on it. I did it at 240 and then another one at like 330. And that I doubled my money on that. I still own it. But I think my average cost on that's like 240. And last I looked, it was over 500. But let's see where it closed at today. Yeah, CrowdStrike 515. I mean, total no-brainer. Now, Fortinet, let's take a look at it real time. So, full disclosure, I have a massive bias towards CrowdStrike. I've actually like dug in big time into CrowdStrike, vouched for the company, the whole 9 yards. Yeah, so these guys, I'll share my screen. Hang on. No. It looks like they gapped down. I don't know what happened. There must have been some bad news. Maybe they had an outage. Let's see. Boom. Okay, so here we've got Fortinet. All right. So, oh, yeah, they must have it crapped out with earnings. So they were at like 97 and then bam, holy crap. Yeah, it went down. Wow, 23 bucks. It has recovered about another 10 bucks since then, but it's way off what it was previously. So obviously they had crummy earnings, and then the more recent earnings didn't really seem to have a super positive effect. Target price 86.52. It does not appear to be a great value at this point. Interestingly enough, I see the ROE 228.04, the ROIC 152. I think that is probably the result of having a very low amount of equity, is my guess. They probably had negative earnings for a while. That being said, the margins look fairly solid. But right now, even with the pullback, I mean, look, bloodbath over here, okay? Neutral, underweight, hold. So they're definitely going the wrong way. I'm a much bigger fan personally of CrowdStrike. I've looked at it, know the company very well. Can definitely, vouch for the company as well. They just have tremendous size, scale, bargaining power. So if you're going to go into that space, CrowdStrike is definitely, the one that I prefer. That being said, CrowdStrike, no joke, I was about to do a video on CrowdStrike. It was in the low 400s. I want to actually see, CRWD. It was, this is pretty recent. Yeah, it was after the tariff madness. Yeah, so it was the spring. No, actually, no, it was the fall. Yes, I remember this. It was like in the low fours. Okay. So I was like, oh, dude, I got to do a video. And it was undervalued, the whole 9 yards. And like right when I was about to drop it, bam, it went over 500 in like a few days. Like if you go look at a stock chart, September 3rd, it was 413.20. September 18th, 502. Like, boom. So it was definitely undervalued when it was down at 400. Doubt that it's undervalued right now, but that's where I'm a huge fan. I'm a huge fan of CrowdStrike. What's your favorite flavor of gasoline? So I kind of just go for whatever the most reasonable is. But my mechanic told me to buy Plus. That's the only thing. And Plus is usually like significantly more expensive, like usually like 15% more expensive than regular. Yeah, I'd say if I If I had a choice, I'd go for Sunoco. But, you know, that's my 2 cents there. Would love if you could look at WHR, Whirlpool. David Tepper increased his position, but I don't see any reason to buy the stock. Not sure if I am missing anything. What is going on with them? That's one of those like old school ones that comes up every so often. There's got to be some sort of like backstory to it. Yeah, this thing's just kind of moved sideways. I'll go show the screen. I haven't looked at that one in a while. There's got to be some sort of like tariff play that like I haven't looked at his exact thesis, but my guess is that's probably what's going on there. Yeah, this has kind of been like fairly underwhelming. It was over 100, now it's at 75. Target's at $80.50. But here's the thing. Look at these. ROA, ROE, ROIC negative. Ugh, not really a fan. I mean, operating margin 5.26%. I honestly have no idea what he's seeing. He must be seeing something that nobody else is seeing. B of A downgraded them. Motley Fool has an article. Why billionaire David Tepper just sold 92% of United Health Group. For our United Health friend. And is buying these 3 stocks instead. It's Motley Fool, so it's going to be in advertising. Now I'm going to have to share this tab. Hang on. Let's see. Probably profit taking. Yeah, he loaded up on Whirlpool, Qualcomm, and AMD. Okay, I could see why the other two. All right, bailing on a healthcare giant. Okay. He aggressively bought in the second quarter, 2.28 million. My theory was that it was rare for a blue chip to be available at a steep discount. Okay. But why did he sell nearly all of it just 1 quarter later? He would have pocketed a gain around 29%. Okay. A whirlpool of AI stock buying. Okay. More interesting question. Why did Tepper do with the freed up cash, drastically reducing their stake in United Health when they bought Whirlpool? Wow. Okay. He liked the appliance manufacturer's valuation after its shares plunged more than 40% below the peak set earlier this year. Okay. It doesn't really give a reason why. Forward PE of 12. Economic uncertainty makes me cautious about buying a consumer cyclical stock. Ditto. I can't figure it out. From a fundamentals perspective, there's nothing that I see in the fundamentals that makes me like want to dig into Whirlpool, buy Whirlpool, etc. But there's got to be some deeper piece. Now, maybe what he's doing is he's trying to get like a controlling stake, seats on the board, break up the company. It's probably something like that because the fundamentals are definitely not there. Not there. I guess this is Mag 7 companies make up 30%, so it's not as diverse. I don't know. I only have 1,000 in SPY right now. Yep. I mean, you're getting exposure to the Mag 7. All right, so hold on. Let's see. What price should I stop buying Celsius? So last time we looked at it, I think we had a valuation of 78, I want to say. So let's see. 78 divided by 1.2, 65 is a 20% discount. But I mean, geez, right now it's in like the 40s. So it's at a massive freaking discount. 44.30. So it's up 5%. I mean, geez, let's see, 78 divided by 44 spot 3. Damn, it's at a 76% discount. So there's worse things you could do with your money. You're not getting the S&P 500 at a massive discount. But yeah, really Celsius at 78 fair value, 65 is still a 20% discount. So I would say you have to figure out what your percentage allocation that you're comfortable with, 20%, 30%, whatever that is. And then just cut it at that point. But I mean, it hits its intrinsic value, you're going to be very happy, as will I. Have you heard of Zeta Holdings? Sounds like a fraternity or a sorority. Definitely gaining steam. Zeta. No, I do not know of Zeta, but let's take a look. Zeta. The Zetas. Let's see. ZETA. Zeta Global. Tech software infrastructure. All right, let's share our screen. Zeta. Zeta. Coming at ya. Target 29.67. Dang. That's a 50% discount right there. Here's what I don't like. Returns negative. Operating margin 0.63%. Citigroup initiated a buy at 26. Okay, 30% upside. That's stale. So this is the most relevant recent one. AI agents. Okay, interesting. Yeah, it seems to be a smaller cap name. AI based. Anything AI. AI. Not familiar with it. That being said, I don't really like the fundamentals on it, but it appears to be significantly undervalued. So you're not off course there, my friend. You're not off course there. Hey, again, I recently learned about RCAT. It's a fund company similar to Joby. They are in the tactical drone business. Cool. Recently received NATO approval. I feel this may help them expand quickly. That's an interesting one. The whole thing with that space is there has to be some sort of like catch. So I was going for Joby based on their technology, who was backing them, and who was leading the company. That's what really got me interested. They seem to be like much further along than other providers in that particular space. But like what you're talking about with RCAT sounds like super, super niche. That one sounds very, very interesting. Very interesting. I'd have to look at the details of the contract. That would be something to look into. Like how ironclad is that contract? That's what I'd have to take a look at. Let's see. Yeah, dude, I did answer your Celsius question. Zeta. Yes. Oh, dude, you went to do the dishes. Come on. Yeah, so Celsius is definitely it's at a 20% discount, 65. So the fair value in our last model was 78. So right now at 44.30, it's at a 76% discount. So you just have to figure out what percentage allocation. So yes, we did answer the question. Any Western Ivy Queensmith target schools? NYU is a very good school. Obviously, I'm biased towards Rutgers, as well as Boston University, very good school. But there's a lot of schools that have like a kind of like a niche following, like Notre Dame. You know, like Notre Dame has a huge presence on Wall Street. UVA, University of Virginia, they have a huge presence on Wall Street. Duke. Those are the types of schools that are like non-Ivy, but definitely have a big presence. And that's really what you want. You want not just what you're going to learn, but the network that you're getting into. That is, that's the key. That's the key. Which of the big bank financial analysts like Goldman Sachs, Bank of America, JP Morgan do you listen to? Good question. On the tech side, I do listen to Dan Ives. He's the Wedbush guy. He always wears like weird colors and stuff. He's a very smart guy when it comes to tech. It's not like I listen to a particular bank more than another. There's certain analysts like in different spaces. So like another guy, Dan Niles, he's another big tech analyst. So you either kind of like listen to a particular analyst more so than like a bank. banks will kind of release thematic research, but I wouldn't say like JP Morgan's better or worse than Goldman Sachs in fill in the blank area. So I always want to get perspective. I always get a kick out of when people are like Wall Street, like oh scam, da da da. It's like, dude, a Wall Street equity research analyst, if they're wrong, they get fired. So they have no incentive to be like BSing numbers and stuff like that. You know, I will say I do have like somewhat of a bias towards like bulge bracket. Um, that being said, like smaller places, you know, they're not going to take coverage on like every stock. They're going to be very hyper specific. So I think there's like a very obvious viewpoint that you will be able to get by looking at the different equity research analysts, but I wouldn't say I'm like biased towards a particular firm's research. I kind of look at individual analysts more so, but honestly, you really can't go wrong. What you want to do is get multiple perspectives. So if I were asking you, for example, hey, I'm in the market for a car, what do you think? And then you'd probably ask me questions. You'd say, okay, give me some of your background. It's like, I'm single, no kids, no pets. You know, I want good gas mileage. So then you say, oh, okay, you know, maybe consider this, this, and this. But I'm going to take your opinion. Then I'm going to go ask multiple other people, and I'm going to use all of those data points to kind of come to my own view. So I wouldn't necessarily say like a particular bank. Now, if you're like, hey, I'm saying this because I want to work in equity research. Yeah, any of the bulge brackets, you pretty much can't go wrong. That being said, I think you probably have a really awesome experience at some of these boutiques like a Susquehanna, Wolf Research. There's a lot of smaller shops out there. Like they get paid for research and there's no other way that they get compensated. So if they do a crappy job, like nobody's going to use them. So that's why I like those, you know, boutique places as well. Uh, do you know the Wall Street Prep? Yes, I do. Um, Again, I'm not going to say anything negative, but they teach to a template and you don't build from a template in the real world on Wall Street. So I'll leave it at that. I don't teach to a template. What are your top 5 investors of all time to follow or like their strategy? That's a good question. Buffett, obviously, no brainer there. He's definitely up there. Bill Ackman, I'm a huge fan. He's had a great track record, like 40%, you know, compound annual growth rate over the last 2 decades. So he's a real good one. But I'm always curious, like the real, like hardcore value investors in terms of current people that are still in the game. So I mentioned previously Aquamarine, that's Guy Spire. Um, who else? Manesh Prabrai, Dondo investor. But like looking back in terms of success, Bill Miller. Bill Miller, Leg Mason, beat the S&P 500 15 years in a row. He was somebody that I always followed. He was tremendous. He was absolutely tremendous. So I would definitely add him to like the Mount Rushmore of all-time investors. Ben Graham's another interesting one. The problem that you run into with Ben Graham is you'll find a lot of stuff that shows to be a value. He did what was called net current asset value. The issue is a lot of those companies are at a tremendous discount, but like they're not long for this world. So you'll find like a typewriter business or a business that sells like pagers, like beepers. And like, yes, they'll be at a massive discount, but like there's no future potential. But I do really like this book, Value Investing from Graham to Buffett and Beyond. I cannot speak highly enough about this book. Let's pull it up. Here we go. So Bruce Greenwald runs the value investing program at Columbia Business School. And I'll share my screen. he profiles a bunch of different investors in this book. Now that I think about it, I have to like dust it off because it is a phenomenal book. So everybody on here, highly, highly, highly recommend this book. So you see right here, he profiles Warren Buffett, Michael Price. He's another classic value investor. Unbelievable. Mario Gabelli. Who else? Paul Sonkin. He's another big time value guy. Christopher Brown. He wrote the little book of value investing. Phenomenal. This book is like worth its weight in gold. Cannot speak highly enough about that book. If you're like really into investing, specifically value investing, like can't say enough about that book. 100%. Phenomenal, phenomenal, phenomenal book. Since I'm 15, I want to be risky. Okay. And then 3 years after high school, I'm enlisting in the Marines. Nice. Semper Fi. And that's when I'm probably going to put more money in S&P. Okay. That's cool. All good. Yeah. Both my cousins are Marines. Definitely a smart move. You're going to make a lot of money and have some pretty cool experiences. Ooh, I'm really interested in investing in MasterCard, but I feel like it's currently overvalued. I would respectfully disagree with you. So MasterCard and Visa have a duopoly. Okay. Now MasterCard, I was actually going to do a video on MasterCard. I own MasterCard. I'm a huge fan of MasterCard, but as you will see in a moment, when I share my screen, the stock has just kind of been going sideways for a bit. But when I was looking at it, it was undervalued, and it's pulled back, so it's now at 540. Target price 660. Yeah, I had it in like the mid sixes. So it's it's at a 20% discount right now. Based upon that, great margins. I mean, look at this. Return on invested capital, 53%. Return on equity, 185.74. Insane. Look at the gross margin, 96.58. Like, profit margin, 45.24. One of my buddies who runs a $2 billion family office, like when we talk about MasterCard and Visa, he says like they're literally cash machines. Like, literally. Interesting. HSBC came out today. They upgraded from a hold to a buy with a 633 price target. Initiating coverage, Citigroup and Wells Fargo, late October, not that long ago, 735, 669. So yeah, that definitely looks to be undervalued. It's like just at a 20% discount though. It's not like some massive undervaluation. That one's a no-brainer. I think I bought it at 340. I think 340 is my average cost on it. That's one that you just buy and you hold forever and you never sell. But it's not a super volatile stock. But when you can get it at a discount, that one's really solid. So I would definitely dig into that. Huge fan of both. I think that is at a greater relative discount than Visa is, but it's basically a duopoly. Total no-brainer. Have you looked on the GLP-1 drugs? Yes. Trying to understand some future opportunities in that space if there are any. So Novo Nordisk has absolutely crapped out, has not been performing well. It is a highly, highly competitive space. And I think the other challenge we have is we don't have a fundamental understanding of the long-term impacts of these GLP-1 drugs. Is it good to not be fat? Yes. But it's indiscriminate in terms of the type of weight that you lose. So you're losing weight. So you're not just losing fat. You're losing both fat and muscle. That's where you have to be really careful. My other contention is it's not like a forever thing. So you're going to get onto the GLP-1s, you're going to lose a ton of weight, and then you're going to get off. Now, maybe you'll yo-yo back and become fat again. And again, don't be offended. Like, oh, Ken doesn't like fat people. I'm just like spitballing. So don't be offended. But I think highly competitive space. And we just don't know the long-term impacts. So I'm not a huge fan of pharmaceutical companies in general because they have to keep that pipeline going. In the past, like Teva was at a pretty significant discount. I think Buffett even bought some of that, but I would be very careful and tread lightly with the GLP ones, 100%. Oh my gosh, Cooper, good point. Stan Druckenmiller, yes, another freaking phenomenal investor. Totally forgot him. Yes, huge fan of Stan Druckenmiller, Duquesne Asset Management. That's where he went to school, ironically. So yeah, he's another goat. And that's the thing. I would encourage everybody. Okay, obviously, we love Ken, the channel, the whole 9 yards. But if you're looking for opportunities, you want to look and see what some of these like all-time amazing great investors, and also you guys positively impacted me the last live stream talking about other videos to do, the 13 Fs. That's something I'm definitely going to be rolling out, and I'll probably do it based on some of these like classic investors and look at their holdings, because it's not like all super smart value investors hold the exact same stuff. There is a bunch of overlap, but it's not the case that they all hold the same thing. Like during COVID, the reason why I bought Occidental Petroleum, Oxy, OXY, was Warren Buffett and Carl Icahn had billions invested in Occidental Petroleum, and their average cost between the two of them was like 35 to 38. I bought it at like $10. So I was like, there's no way these guys are going to lose money on this thing. But also, if they own it at 35 to 38, they think it's worth 50 to 60. Total no brainer. So that's another thing that you could do, is kind of like ride the coattails of some of these like unbelievable and incredible investors. I would always recommend checking that out. Do you think the market's growth is mainly driven by the Magnificent Seven? Yes. Yes, it is. We talked about this earlier. If you strip out the Mag 7, I'm curious what the latest is. If you strip out Mag 7, what is performance of the rest of the S&P 500? I'm curious. We got Gemini on the track. All right, so here we go. I'm going to share my screen, because from what I recall, it was either like neutral or it was actually like negative. So yes, it is driving the value of the market in the S&P. Okay, in 2024, the S&P 500 was up substantially, but the other 493 stocks lagged. Aha, I was right. With some sources showing roughly 7% gain versus the overall index's 16% plus. Sounds about right. But yes, there's volatility. Okay, so 2024 data. S&P 500 total, 43%. Equal weight, excluding Mag 7, up 20%. Mag 7 accounted for a massive portion. From a weight perspective, it's like a third. But yeah, it definitely drives the bulk of the performance for sure. There's no question. Ooh, good question. Would you recommend growth or dividend stocks? So, when you're a value investor, which I think in general we kind of all are, we don't want to overpay for stuff. I've never understood the idea of like straight growth investing, which is basically buy $1 because you think it's going to go to like more than $1. I like buying $1 for 50 cents. So I would say I'm kind of like value and then GARP. GARP is growth at a reasonable price. So growth at a reasonable price is basically, I want growth, but I don't want to overpay for it. Now, growth stocks versus dividend stocks. A dividend stock, when a company pays out a dividend, with the exception of like an Nvidia or a Meta, typically companies will pay a dividend because they cannot get a better return on their invested capital than you could. So they're like, here, we're going to give it to you. That's like the corporate finance definition. You're not going to get the same level of core growth from a dividend stock. Now, I would always advise reinvest the dividends for sure, but they're not going to perform at the same level as the growth stocks. Now, the counterpoint is the dividend stocks will typically have less volatility. So you have to kind of balance out, which are you more interested in, price appreciation or income? that's kind of what I would say in a parallel process. I mean, look at Berkshire Hathaway, still doesn't pay a dividend. Crazy. So I would say if you're on the younger side, which I would say in general we all are, I would lean more towards growth, but not overpaying for it than dividend stocks. So like if you invested in, like a dividend ETF, it's going to underperform the S&P 500, but you're going to get the dividend. So if you don't need the income, I would much prefer a growth opportunity. Obviously, I own a bunch of dividend paying stocks, but I would rather buy something that's growing that I can get at a decent discount than like a dividend stock in general. You're going to have a lot more upside with the growth stocks typically. What do you think about PGY and MNDY? I don't have any particular opinion, but let's go take a look. PGY. Good old Pagaya Technologies. Interesting. Yeah, there's all these like stocks out there. I'd rather personally just invest in like a known quantity. And it looks like Pagaya, not to be confused with papaya, has pulled back pretty significantly. So it was like 44, 45, and now it's 24. So it's almost been cut in half since October. Target price 40.80, so it's definitely at a massive discount. But here's the thing: negative returns. ROE negative 42.38, ROIC negative 17.03. Not a huge fan. Not a huge fan. Negative profit. Let's see if they have. I mean, they must have analyst coverage. Price target 22. Man, that's not that great. Oh, but that was back in June. Okay, so here we go. An AI credit platform. Yikes. I mean, look, it's undervalued, but you're probably going to have to deal with a decent amount of volatility there. And then MNDY, Monday.com. Wow, this is hit the skids. This one's another one's down like 50% from a few months ago. When something goes down that much, that quickly, you have to say, like, what happened here? Yep, target 235, so it's a massive discount. This one I like better. I like this better because it at least has positive returns. Still not like, wow. Return on invested capital, 4.8%. Return on equity, 5.8%. Doesn't really excite me. Crazy gross margin. Awesome gross margin, but operating margin. They obviously have a high cost structure. Probably paying out a lot of folks, maybe a lot of R&D there. Kind of odd that their operating margin is less than their profit margin. They must have like tax credits. Initiated coverage, Guggenheim, price target 250. Yeah, so both are at a significant discount. Of the two, though, I like this one, Monday, as opposed to Pagaya. Pagaya makes you think of papaya. Papaya is pretty good, actually. Anti-inflammatory. Hello, Ken. I'm going to Boston College for finance. Congrats. That's awesome. Trying to figure out what type of finance career to get into. What types of questions should I ask myself, or where should I research? So first off, congratulations. Great school. You have to figure out your personality. And if you are more like impulsive, fast-paced, stuff like that, that's going to be sales and trading. If, on the other hand, you kind of like to have your time to think through things, come up with a thesis, work through problems, issues, that's more kind of like sell side investment banking, equity research. You're going to have the most optionality through investment banking, but that's also the hardest job to get. Crazy hours, 100 hours a week. What I do want to throw out there, on my board of advisors for the Road to Wall Street, we were talking about this the other day, like job opportunities. And like one of the biggest areas that people don't focus on is what's called prime brokerage. So prime brokerage is what facilitates investing. It's basically a service. They facilitate investing for hedge funds, huge asset managers. So for example, if a company wants to short, they need to obviously borrow stock. So prime brokerage will facilitate that. If a hedge fund's going to use leverage, prime brokerage will facilitate that. So I would say it's a function of personality. If you find that you like to have more time to like think through stuff, come up with like a thesis, that would be more, investment banking, sell side equity research. But if you're like fast paced, like go, 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 every day you want to be different, you need novelty, stuff like that. That would be more sales and trading. I know that's like a super high level perspective. The other thing I would advise is networking. From networking, you're going to see from the people that you talk to what you're interested in and what you like. That would be my advice to you. But great school. Boston College is a fantastic school. But I would say network like ASAP. And through that process, you're going to recognize pretty quickly, like, yeah, you know what? I think this is my track, my lane. The other thing, too, is the theme that I have for my Road to Wall Street program at Rutgers: where you start is not where you're going to finish. So figure out what you're interested in, try it out, obviously, ideally through your internships, and then you can always pivot from there. I would also advise, best thing for you to do, go for a name brand, okay? Go for a JP Morgan, a Deutsche Bank, a Morgan Stanley, a Goldman Sachs, a Bank of America, a Wells Fargo. Those are huge organizations. And if you find like you don't really like a particular area that you're working, guess what? You can pivot. You can do a lateral move within the company. And that would be my advice to you there. But just great job, and do the networking though. Definitely do the networking. 100%. Favorite podcasts? So I actually am not like into finance podcasts, to be quite honest with you. Like I usually am listening to podcasts when I'm walking, and when I'm walking, I usually want to just kind of like think, or like get my mind into like a different headspace. So I'm a big fan of like Andrew Huberman, the Huberman Lab podcast. He has some pretty cool guests. Also like personal development. So a guy like Ed Milet, he's good. I've got my good friend Jeff Lerner, Unlock Your Potential. That's another good one. So when I listen to podcasts, I'm usually not looking at like finance podcasts because I kind of have like information overload. And I kind of want something different. So I apologize because you're probably like, what finance podcasts? But eventually we're going to have a podcast. I think the live stream is kind of dipping the toe in the water for the whole podcast thing. But my podcast thought was more so like me interviewing people that work in finance so that you guys can get a sense of what the different opportunities are out there in finance, because there's a lot of stuff out there. Do you think Berkshire Hathaway will tank after Buffett dies? I do think the stock will pull back. I don't think it will tank. And that's also the logic as to why he's handing over the reins to Greg Abel and others. And as a result of that, I just don't think it's going to tank, because what's going to happen is you're going to associate Berkshire Hathaway with Greg Abel more so than with Warren Buffett. So just like when Charlie Munger passed away, it didn't tank. I would say the same thing is probably going to be the case. It's going to happen eventually. He's not going to live forever, but I think that's why he's passing the torch. I think that's really the key there. Yeah, Cooper took the words out of my mouth. Yeah, it's been priced in. Yeah, I don't think it'll tank. What's your take on tokenization, stablecoin? I'm considering building my position in Ethereum. I own Ethereum. I'm a fan. I own Solana. I'm a fan. I own Bitcoin. I'm a fan. That being said, of like my overall investment portfolio, 1%, might even be less than 1%. I'm just not like a big like crypto nut. I like cash flow. So I am a fan. I think, blockchain technology is phenomenal. It's going to make a lot more things efficient. Like, for example, when you sell a stock, Like the fact that you have to wait 3 days is just stupid. That's going away within the next couple of years as a result of blockchain technology. But yes, I am a fan of Ethereum, Solana, and Bitcoin, 100%. I might sell some of my UNH now and split it up between my top 5 stocks. I don't think that's a bad move, assuming that you bought it at, when it was down. It's not something that I would hold for the like long term. Like it'll be higher 5 years from now than it will be today, but it's not like a high return business. Like we talk about like the Mag 7 stuff like that, definitely far from it. Like worlds apart. Worlds apart. What do you think about Elf Beauty if you've ever looked into it? We talked about that a few weeks ago, actually. I had mentioned Ulta. That was another one. I think Buffett even got into Ulta Beauty. The whole thing I would say is this. Full disclosure, I don't wear makeup. I know it might be shocking to you. This is me, au natural. You really need to speak to people that are using their products and services. The biggest mistake I've made as an investor historically is just looking at the numbers and being like, wow, this is amazing. And not having those conversations like, what do you think about this? It's like Sephora being a good example. If you talk to women, they love Sephora. They could spend like a whole day in Sephora. All right. I'm like the stereotypical guy. Whatever I need, I go, I buy, and I leave. I'm not trying stuff. I'm not doing this. It's like I need a pair of jeans. I know what I wear. I look at the style. I'll try it on and I'll buy like 5 pairs and then you won't see me for like a year. That's very different with the beauty space. So I have come across it. But I would say that would be something that the numbers tell part of the story, but you want to find people that are like rabid about the company. They're like, oh my gosh, like this is an amazing company. Love it. I would literally pay more for their products as opposed to another company because of ABC XYZ. But I typically don't invest in stuff that I personally don't understand. I get the whole logic of like makeup, but when you talk to women, like they're going to give you a totally different perspective on it. So that would be my advice with Elf Beauty, Ulta Beauty, Sephora, any of those companies. Greetings upon thee, Ken. Greetings upon thee. Going medieval. Dun, dun, dun. What do you do with a position that's 20x and becomes 32% of your portfolio? This is an excellent question. In my case, that's Palantir, which I know is a bit of a cult valuation right now. It is. That being said, though, it's not coming down. Like, so I would not go the Michael Burry route and like short Palantir. That is a Sisyphean effort, as they say. So what you have to do is decide like, where are you comfortable versus uncomfortable? The fact that you have a 20x gain, first off, congratulations, great. I wouldn't just sell it because it's a 20x gain, because it might go another 20x and then you'll be kicking yourself. The bigger thing is exposure. Warren Buffett, 50% of Berkshire's portfolio, 50 was in Apple. Okay. He said, it's just too much of an exposure. I want to trim it back. Now, he trimmed it back to 30%, which is still a very, very large exposure. He lost $900 million of gains through that process. So it really boils down to, are you comfortable with that? If you're like, yeah, I'm comfortable with it, and you know there's going to be volatility and there are going to be pullbacks, I'm not opposed to it. Also, another way to fix your weight issue is just put more capital into the portfolio. And that's another thing. So that's kind of how I look at weights as well. Sometimes I'm like, geez, like Joby was like 24% of my portfolio. So I was like, but I'm also like, I'm not going to just sell it because it's 24% of my portfolio. The rule of thumb is if something's undervalued, like you still want to hold it. It's really a function of your comfort in having that level of exposure. My big thing though is I like to solve the whole weight and exposure issue by just putting more money in the portfolio. That'll help it like real fast. You want to bring Palantir down? Don't sell it. Just invest more in the portfolio. Is it overvalued? Yes, it is, by the way. But When I did the Tesla video a few weeks ago, I said Tesla's overvalued. If you don't own it, don't buy it right here, period. But I also said, if you hold it, okay, currently, like me, don't sell it just because of that. The fundamentals are there. It's still, going to have a long trajectory up and to the right. So that would also be kind of my take and perspective for you as well. So that would be my 2 cents. I wouldn't necessarily be like, oh my gosh, 30%. That's not an issue. Sorry, I'm catching up in the chat here, folks. Your podcast idea is great. I would watch it. I bet you know some interesting people. I do know some interesting people. And I've thought about this. The other thing too is like I have a lot of former students that are working on Wall Street in a whole bunch of different areas. So it would kind of be like you'd get like a peek into what their day-to-day is like, what their life is like. And I think there would be value to that. And just seeing kind of like the inner workings of Wall Street, because a lot of people have all these like misconceptions. They think of Wall Street like the movies and stuff like that. It's not like that at all. All right, so I've got at least one person that thinks that would be a good idea. Yes, good old Charlie Munger. Bitcoin is rat poison. Don't be offended, folks. Don't be offended. We're not anti-Bitcoin here. Have you heard of XRP? Yes. It had the most institutional inflow out of all the cryptos, consequently caught a lot of investor attention, has an interesting consensus mechanism and innovative. So I haven't honestly looked into it. I am aware that everybody went like cuckoo for Cocoa Puffs with it, but I haven't dug into it enough to give you like an opinion one way or the other. What I would say is, Bitcoin, Ethereum, Solana, they each have their own logic and mechanisms behind why you would want to get exposure to them. And if you do the research and you're like, yes, that like this is innovative, novel, etc., then by all means, expose yourself to it. I think where you have to be careful is the volatility side. Just be prepared for the volatility. Like, Bitcoin, boom, goes down 30%. Everybody's posting memes about they're going to work at McDonald's and stuff like that. That's investing, man. It's not for the faint of heart. If investing were easy, everybody would do it. And it would just go up and to the right. Now, ironically, that's pretty much what it has done since COVID. But if you look back in April, when we had the tariff craziness, people are like, oh my gosh, what's going on? And I'm like, what's going on? Like, obviously the market's trying to assimilate, tariffs. And it's not something they've had to do for like 100 years. So yeah, it's going to have an impact. But in general, I think you have to decide like how much volatility you're willing to stomach. All right, here we go. Good. So you're doing some research. I've talked to girls at my school about ELF. They all seem to like it. Also, Alani Nu they love. Yeah. I would check it out. Honestly, I would look more into the company then. But if you've already done the research and you found out like the main consumer of this product, they love it, that's a huge positive. Huge positive. Interesting. There's a Dutch version of Amazon called Bull. If Bull finally comes to the stock market, I will invest in that so hard. Again, my assumption is you've done business with this company and you're a fan of it. I wouldn't be opposed to that. I'm always a little leery personally of like regional versions of things. So someone brought up Mercado Libre a few weeks ago. And it's like, yeah, I just don't want the exposure to the markets in which they operate. So I would rather invest in Amazon. But again, for you being in Europe, having that exposure, that's not like a negative at all whatsoever. And if you use the company and you're a fan of the company, that is going to be huge. That's going to be the case. So good for you. I'll be on the lookout for that. I still don't understand the value of Bitcoin. Join the club. I feel like Ethereum and Solana, the blockchain technologies that support them, can transform the entire financial industry. So Bitcoin at this point has first mover advantage, has a ton of institutional backing. So Bitcoin's not going away. The logic for the valuation, Can't tell you. You know, you'll hear people like, oh, it's going to be 250 by year end. It's like, 3 weeks. It's like, yep. Then you'll hear other people like in X number of years, one Bitcoin is going to be, $13 million. Like you could see all the stuff Michael Saylor has out there. What you also see is the volatility. A lot of people have levered exposure to Bitcoin so that when Bitcoin goes down and they have a margin call and they have to unwind their position, that's where you see it go down like that. So me personally, like I'm not one of these people that's ever going to have like 50% of my portfolio in Bitcoin, maybe like 5%. But, people are like, you're stupid. It's like, I like cash flow. I would rather invest in companies that have cash flow. That's just me. But yes, I cannot tell you the logic of it. I understand there's a limited amount, like 21 million. I get all of that stuff. But it's its own created construct. That is the issue. If you had to open a hedge fund, how would you go about raising money and how would you sell your strategy? So I'd go to a lot of my friends that have money, and that would be step number one. Step number two, value investing focus. Long term, you're not going to outperform the market in a month, but over time, you definitely should. Being very conservative in the approach and buying stuff when it's at a significant discount. So I tend to like not a 20% discount, but like a 40% discount. If I could get a 40 to 50% discount, like when I bought Tesla, I had a value of it at 280 and I bought it at 140. It's a 100% discount. Like pretty hard to mess that up. Same thing with CrowdStrike. We were talking about that one earlier. It was at 398. It went down to 210, I think was the low at the time. And it's like, hold on a second. This is another one that's at 100% potential upside. That's the type of stuff I like investing in. The question then is, how long do you hold it for? I think a company like CrowdStrike has a much longer term investment thesis and potential as opposed to like a Celsius. I think Celsius is eventually going to get bought out by Pepsi. But remember, it's just like it's Celsius, Alani Nu, and Rockstar North America. Those are the three brands that they have. So Celsius is not going to be Pepsi or Coca-Cola. Like they just don't have the brand portfolio. So you'd have to decide like how long you're actually going to hold it. Is it going to be like a long-term forever thing? I have a friend I've known my whole life that has offers for D1 softball from 30 D1 programs and will get a heavy NIL deal. She wants me to manage her money for her. How would I legally do that? Oh boy. Also, don't think I'm qualified to do that, but I was wondering. Yeah, so you would have to be an RIA, a registered investment advisor. So you are accurate. You probably don't have the qualifications for it. That being said, like simple advice, just say dollar cost average S&P 500. That would be the safest thing to do. D1 softball, she'll get like probably tens of thousands, maybe hundreds of thousands, but I would like that would be my 2 cents. Dollar cost average VOO versus like trying to like double, quadruple, triple it. You want to at least the whole thing. Warren Buffett, rule number one, don't lose money. Rule number two, don't forget rule number one. That's kind of the mindset that you want to have with that. But also like that's where you would potentially go into, other asset classes, real estate, things like that, not necessarily just stocks. So almost take like a family office approach to it. That's kind of how I would think about it. Speaking of McDonald's, for dividend stocks, what's your take about MCD versus ABBV? So I'm actually quite familiar with McDonald's because we model McDonald's in my class. AbbVie again, pharma. I'll pull it up for you on FinViz. It looks like it's not a massive discount with AbbVie. A company like McDonald's, you're just not going to get like crazy upside with it. So here's the target price on AbbVie. 10% discount. So it's not at a significant discount. Also, return on invested capital, 3.89. Not really wow on that. McDonald's, my prediction is that because McDonald's is 95% franchise, eventually they're going to restructure to a REIT. I mean, you see over the last year, hasn't really done anything too crazy. Performance year, 4.98%. Target price, 333.07. So another one, not at a significant discount, better fundamentals, return on invested capital, 16.45, better margins. So if I had the choice of the two, I would rather be in McDonald's as opposed to AbbVie. Also, much easier business model to understand. Checking out the chat. I'm behind. Sorry. What international or not necessarily popular stocks are you bullish on? And have you heard of Nomad? Let's see. NOMD. I don't think I've heard. No, actually, no, I have heard of Nomad. Nomad Foods. That is down pretty significantly. Now, I might be thinking of a different company, but I'm pretty sure I looked at Nomad and I had issues with accounting that I couldn't really wrap my head around. I mean, this thing's down pretty substantially. 12. Target 1687. So, you know, it's definitely at a discount, like what, 30, 25, 30% discount. Return on invested capital, 4.07. Margins, okay. Let's see what analysts. Goldman has them at, oh, geez. 2023. I think that's a little stale. I'd be curious with a company like Nomad, what is going on in terms of them and tariffs? Like United Kingdom, but how much are they actually impacted, if at all? Like, are they selling into the US? Like, what markets are they most exposed to? That would be the stuff that I'd be curious with. In terms of international names, you know, in the past, Nestle is one that I've gotten into. Usually with the international names, I want them to have an ADR. I don't want to do any direct investing because there's tax implications, there's currency fluctuations. So that's the type of stuff that I'm pretty cognizant of that leads me to kind of like only focus on ADRs. But I'm not like opposed. I mean, especially some of you are international, but there's none that I could say like, oh my gosh, you got to check this out. I know Buffett invested in BYD in the past, but then divested of it. I'm usually a fan of domestic U.S. based companies, or if they are international, they have an ADR. Like so, Nestle was like NSRGY .pk. It trades as a pink sheet, but net, I would say I'm not opposed to it, but I don't have a name that I could like throw out at you off the top of my head. I pretty much focus on like U.S. Although I want to check out this bowl. Okay, here we go. Bowl. Bowl is bought by supermarket chain Albert Hagen, which is on the stock market, but there were talks in 2022 of Bowl getting a separate listing. Okay, that's interesting. I just want to make sure that I don't miss any comments here. The scroll thing on this is like the width of a human hair. It's like so difficult to catch it with the cursor. Probably my biggest complaint about this platform that I use, which is Riverside. Everything else is good, but it's just like, my gosh. Why wouldn't I have 100% of my portfolio in index funds when most mutual funds and hedge funds managed by professionals can't outperform the S&P 500 in the long run? That's literally the argument I made earlier. I wouldn't advise that. I would say S&P 500 VOO. 98% of professionals can't beat the S&P 500 over a 10-year time frame. So why wouldn't you? I don't know. Why wouldn't you? I don't see any reason to not. Again, me personally, like full disclosure, my 401k IRA is VOO. And then beyond that, that's where I'm investing in individual stocks, the stuff I cover on the YouTube channel. 100%. Yeah. Why wouldn't you? I don't know. There's no reason not to. This summer I wanted to do an internship in Sacramento. I live there with a stockbroker. Do you think that those are good internships? So stockbroker, if they're like an investment advisor, I would say that would be cool. I mean, stockbroker, I think stockbroker is kind of like what people say, but my guess is this person probably is an RIA, registered investment advisor. They probably manage people's money. Yeah, I think that would be a good experience for you. Get your feet wet, learn the business, learn what you like, what you don't like. You'll probably have a lot of client interaction, which is a skill that's going to be that much more important, especially in like an AI world. So yeah, I think that's a smart idea. I would do it 100%. What do you think of Procter and Gamble on this huge dip right now? Let's go take a look at Procter and Gamble. You know, Procter and Gamble, Colgate Palmolive, those types of companies very rarely are at a discount. I mean, so many major brands with a Procter and Gamble, a Colgate Palmolive, Church and Dwight, Clorox, a lot of these companies. You see right here though, consumer defensive. So it's more of like a hedge. If you were worried about the market, the economy, etc., that's where a Procter and Gamble will do better than the rest. You know, Target 169.71, let's call it 170. It's at, you know, it's definitely at a discount. Um, Great returns, phenomenal returns. I'm a fan of Procter and Gamble. I mean, you're not going to get some like crazy return on it, but look, today, Deutsche Bank, Barclays, literally today, um, Deutsche Bank moved down its target 176 to 171. Barclays moved it down 153 to 151. I would be hoping that the Deutsche Bank target is the right one. So it's at a discount. It's not a massive discount. You know, you basically say a 10% discount would be 1383 above this. So you're basically talking that 151, 152. That's a 10% discount. So then you need another 13 on top of that. So I would say if it gets like to 130, it gets a lot more interesting. But again, you know, it's a stock that's very defensive. If you're concerned about the economy, you know, you think the market's overvalued, stuff like that, you know, that would be a play. I would say more so in like that 130 would be a good entry on that one. Uh, this one's come up a bunch recently, Copart. Um, so Copart's like an auction platform. I've only looked at it because a few of you have mentioned it and brought it on the radar. Um, I'd have to dig into it a little bit more. I know it's an auction platform. Um, it's an interesting business. You obviously need to get the product if you're like the go-to. I mean, you know, you could argue eBay is an auction platform, obviously to a different extent. So a few people have brought Copart on the radar. The big thing that you have to do stepping back is like, what is their competitive advantage on a relative basis? So why are people using them as a platform as opposed to other alternatives? It's definitely a niche business. There's no question about that. It's definitely a niche business. But I haven't dug into it. It's one of those ones that's like, when I get around to it, I am going to look at it. But it is a very interesting business model for sure. Is Disney the real winner on this Warner Brothers, Paramount, Netflix confusion? Disney has its own issues. La, la, la. I mean, this is really a move to kind of like take like the movie business and the streaming and kind of combine it. We were talking about this earlier. So Netflix is actually building out, ironically, in New Jersey, what they're kind of terming the Hollywood of the East. And what they're trying to do is get into that production side more so than just the content streaming side. I wouldn't say Disney would be the big winner. Disney has its own issues that they have to work through. Um, It's an interesting take, but I don't think Disney's necessarily the big winner. I mean, if Netflix actually gets it, they'd be the big winner, more so than anyone else, I would say. What do you think of the economy of Japan in the long run? So they have an issue like many industrialized countries have with population decline. And that's where I would be a little bit more concerned with Japan. Like they're below replacement rate. A lot of countries in Europe have this issue as well. So those would be the things that I would be more concerned about with Japan is actually like, because you said long term, that is the issue that I think is biggest long term. I actually saw something I was like, is this a joke? Japan, not Japan, China, because of that declining birth rate, they're actually going to be taxing condoms starting next year. And I know that sounds insane, I guess, to encourage people to not use them so that they produce more humans, which sounds crazy, but that would be my biggest concern with Japan is the population decline aspect. But in terms of the economy, I would say bullish, but that would be the thing that I'd be more concerned about with Japan. Fun fact about major companies in the Netherlands, like Philips. When a Dutch company is in a certain amount of years old and provides service to the king, they could put royal in their name. So like Ahold, they have royal in their name. That's interesting. That's why Phillips is called Canong J. Phillips, and I just butchered that. That's interesting. Never knew that. That is a fun fact for sure. What do you think of the whole life insurance as an investment? Ooh, this is an interesting one. Wouldn't buying term life and investing the difference in VOO, VUG be a better option, protecting your dependents and building wealth? So, something for you to look into. There is a whole life that you can get. I know they're like, oh, never get whole life. There's a whole life that you can get that you can structure in a particular way where you could borrow from it at a fixed rate. It's termed infinite banking. That is something I am very much a fan of. I do that myself. Now, if you're just saying like I have a family and I want protection against for them and assets, etc. Yes, you could do that play term over whole life, but I would look into infinite banking. That's what I would advise looking into, and you can find. Guy has a very unique name, but he's the guy that created this as a concept. And the name escapes me, but I need to find the guy's name because you'll be able to find his book. R. Nelson Nash. So I would say, yeah, there we go. He has a book called Becoming Your Own Banker. And basically, it's got a whole life policy where you can borrow from the policy at a fixed rate. You take those borrowings and you invest in businesses, what have you. And then the return that you get, you replace the borrowing. But if you look at it, and again, read the book, it'll be pretty eye-opening and interesting for you. But net, you could borrow at a fixed rate from yourself effectively, never need a bank. You could buy real estate with it. You could buy whatever you want through it. And if you ever went bankrupt, it cannot be taken from you. It cannot be utilized in bankruptcy. So that I would be a bigger fan of. But you could even structure that where you could invest in VOO or various other opportunities. So that I would look at. R. Nelson Nash, Becoming Your Own Banker. Ooh, good question. What is your biggest conviction in this market right now? One that other people would disagree. I would say that AI is not a bubble, particularly the Mag 7. So I would say Amazon, Meta, Microsoft are undervalued and they will do very well on a going forward basis. The whole thing with the whole bubble is the idea of a bubble is where the price is divorced from the fundamentals. So, like, for example, and I gave this example to a buddy of mine, real estate. Real estate is like the easiest thing to value. You have net operating income, you divide it by a cap rate, boom, you get the value. If the value of a piece of real estate was significantly higher than what was justified by taking net operating income divided by the cap rate, that is where you have a bubble. Where you don't have a bubble is where stock prices are going up, but the fundamentals are increasing as well. Bubbles exist where the asset prices are divorced from fundamentals. So that would be, I would say, like my biggest hot take right now that people would probably disagree with. Views on offshore drillers. I've been researching the space for the past 2 weeks. Looks interesting. Would love your take. So this is another one that is more opportunistic in nature. It's really going to be directly connected with oil prices. So that's really what you have to look at. What I would always be curious, any energy play, is what is the break even for that business? So every driller is going to have a break even point, which is what is the price of a barrel of oil, where above that we start making a profit. A lot of times what will happen is when they get below that point, they'll just stop drilling altogether. So drillers do well when, those prices are obviously increasing and they could take advantage of that. I don't particularly think that there's going to be like this massive run up in oil prices. Now, you could argue, well, AI, data centers, fueling of it. I think liquefied natural gas is more of a logical play in that regard. And I think that's what's going to happen. Liquefied natural gas is going to be the number one fuel source for these AI data centers because we just don't have the infrastructure built for the electrical grid, et cetera. Even nuclear, it's like, yes, that would be superior, but we just don't have the infrastructure built out for it yet. Nuclear takes, a decade to get online. So that's a much longer term play. But that would be my 2 cents on the drillers. What do you think about the following narrative? The rise in self-driving and accident prevention technology will decrease accidents, decrease demand on car insurance, which would decrease premiums and decrease revenues for insurance companies. Furthermore, the liability of accidents could be on the producer, resulting in them getting insured, but regardless, still losing revenues. And that's why you shouldn't invest in car insurance for the long term. So, everybody should get car insurance. That's point number one. But in my experience, having lived on this earth for, having a driver's license for a couple decades now, my insurance has never gone down. Okay. So it's not as much a function of accidents and all of that stuff. And here's the thing, as you get older, your insurance premiums will go down because you're less of a risk as a driver. I hear what you're saying in terms of the macro. It will be interesting to see what self-driving technology ends up resulting in from an accident or lack thereof perspective. You probably saw in the news Waymo. They had to take their software offline because the Waymo taxis were going past school buses, which is obviously illegal. Those are kind of like the unintended consequences. I'm curious to see what the evolution is of highways, roads, etc., with self-driving technology. Is there going to be a separate lane for self-driving cars, or are the self-driving cars going to drive with everybody else? That's a good question, because if the answer is they're going to have their own lane, I think then your argument makes a heck of a lot of sense. If the answer is you're not going to have your own lane, they're going to be in traffic, I think you're going to have the same amount of accidents because you just have human error, you have people not paying attention, etc. I see where you're going with it, but I think as a whole, the insurance industry, the premiums do not go down. And the logic is this: on a percentage basis, even if the accidents go down, the cost of the accident is not going down. So it's not necessarily the quantity of accidents, it's the damage that's done with the accidents. Like the cost of the damage is still going up over time. No. Personally, not a fan of infinite banking, as you have to borrow against your own cash basis to withdraw the funds, and you do not get your cash value upon death in most cases. So the counterpoint to that is you're borrowing against your own cash, but the value of the policy is still the same. So the value continues to compound at the total, the gross, not the net. That's the value of infinite banking. So for example, if you had your money in infinite banking or just cash, you have an opportunity cost of that cash, right? That cash isn't making anything once you pull it out, whereas it is still earning on the gross value. But in terms of like not getting the amount at death, yeah, if you borrow the whole amount, they're gonna, rip that out from the settlement value. Yes, that is true. What do you think about QQQM versus VOO for long-term investment? So I'm assuming QQQM is NASDAQ momentum. Let's see, QQQM. It's just Invesco NASDAQ 100. Yeah, I think the only like counterpoint is the exposure. Like, are you comfortable with that much exposure to tech versus VOO? Whereas VOO, you have that 33% exposure to the Mag 7, and then you have that other piece. So if you were actually worried about an AI bubble, you'd be way better off in S&P 500 as opposed to the Qs. I think the reason to invest long or short in the Qs is a volatility play. I would still go with S&P 500 long term. There's going to be less volatility. So like when it pulls back, it's not going to pull back as much with VOO as opposed to the Qs. What do you think of the tech industry as a whole for the future? I feel like VGT is a great investment for retirement, as betting tech in 20 plus years is inconceivable. Yeah, that's kind of the argument I just made there with the QQQM. But let's see, VGT. Vanguard IT ETF. Yeah, it's the same thing. I'd have to see what the constituents are of the Vanguard IT ETF, because it probably has companies that you're not thinking of, like a Qualcomm, or more like technology infrastructure, which is definitely not going to rise at the same level as like the Mag 7. So I would say I'm still, sticking with the VOO, because I wouldn't want like a particular sector exposure, because those are going to, like right now, it's like a no-brainer technology. Yeah, but still, and this has been my premise all along, once the AI boom is done, then what? Like once all the data centers are built and all the NVIDIA chips are in the data centers, then what? Then it's just like the newest, the latest, the replacement. Right now it's a boom because like you have to pack out these data centers with all these chips, all of this stuff. But I don't think they're going to be replacing chips every like month. That's still going to have like a longer cycle to it. Just like if you want an example, look at microprocessor chips. That would be like a good example to look at, and also how innovative is this technology going to be on a going forward basis. So I would still not want like an even greater weight than the 33% that's allocated towards the Mag 7 with the S&P. Any thoughts on Capital Group? They claim their funds provide better downside protection than the S&P 500 and have beaten the market 90% of the time. That's interesting. I'm not familiar with that claim. Typically, though, if you are mitigating downside, you're giving up upside. That's usually the case. So like there's a thing called like a fixed indexed annuity. And what they do is, and it's a crazy concept from like a financial product perspective, but a fixed indexed annuity is basically like if the market goes down, you stay neutral. But when the market goes up, we cap your upside. So the market's up 25%, we're going to give you 8%. If it's up 10%, we're going to give you 8%. If it's up 5%, you're going to get 5%. But when it goes down, you don't lose. So it sounds to me similar to that. You definitely, rule number one, don't lose money. Rule number two, don't forget rule number one. That is true. And if you actually look at it mathematically, if you could never lose, you'd be better off than if you win and lose. But I'm not familiar with their particular claim. Any advice for ADR? I don't have any like on the radar right now at the moment. You know, I've looked at Nestle in the past, Vodafone in the past, Petrobras, which is Brazil. Basically, it's like the equivalent of like Exxon in Brazil. Again, there's none that are like particularly on my radar at the moment because I'm still pretty much focused on like domestic companies, especially the Max 7. But there's none that like I would just go nuts over right now. The whole idea is it's dollar denominated, so you don't get the currency fluctuation that you would from direct investment. But that's not an issue for you since you're in Europe. WSP Global is a company that you are familiar with. I can understand how to value a company like this one. Let's see. WSP Global. It's not even coming up. WS Global? I'm not pulling anything up for WSP Global. It's not coming up. Maybe it's just a non-US company that doesn't have a domestic listing. An AEC firm. Yeah, I'm not familiar with them, but nothing was coming up for the ticker. So I don't know. Maybe they're not publicly traded. I would slightly push back on a couple of things and let me know what you think. Sure. The cost of an accident will remain constant. However, the expected cost will decrease. Okay. Since the probability of crashes decrease, this will cost less for insurance companies. And if human error is perpetually being reduced by emerging technology, less people will require car insurance. You're still going to be required to hold car insurance just from like a government perspective. And governments will remove mandates. I don't see governments ever being okay with you driving without car insurance, even in the self-driving scenario. I mean, it's an interesting thesis. I don't know how exactly you would play it. I don't know if the idea is to like short insurance companies that are exposed to car insurance, but every car insurance company typically has other exposures. So you could argue like self-driving cars are going to have less bad accidents. I could see that, but insurance companies are still going to make tons of money. I mean, you talk about a cash machine, insurance companies just print money. I mean, like crazy. You could argue there's certain types of insurance that you'd want less exposure to, like property and casualty. I see where you're going with it. Again, we just don't know. Like, I don't know if self-driving cars are going to have their own lane. Like, your thesis makes perfect sense. If self-driving cars have their own lane, they're not driving within everybody else. It's like, yeah, it's a foregone conclusion. And then maybe you won't have a mandate there. But the whole issue is it full self-driving all the time? And that's why you're going to need insurance if you ever decide to drive the car. It's also not clear, like the law hasn't stated, like, let's say you go to the bar and you're using your self-driving car and you're in the driver's seat. My understanding is that even with a self-driving car, you still have to be in the driver's seat. So like, can you go to the bar and have a few drinks and be in the driver's seat and say, oh, it's self-driving? I doubt that will be the case. So there's a lot of like uncertainty. It's an evolving thing, and that's where you have to be like pretty careful with that. What do you think of gold as a hedge against the market? Well, right now, more so than a hedge against the market, you see a lot of sovereigns, a lot of governments are like moving towards gold because they want less exposure to fiat currency, paper money. That would be the piece that I would be looking at with the gold. My understanding is that the most recent quarter was the largest quarter of gold buying ever, and it's only continuing to increase. So that's the thing I would say. So I would say I'm like bullish on gold right now at the moment. I don't think it's going to go like $100,000 an ounce or something crazy like that. But yes, it definitely is a hedge. All right. Good night, my friend. Okay. Here we go. We got the ticker now. WSPGF. WSPGF. This is the WS Global. WSPGF. I'm going to have to pull it up on like Yahoo. It's not coming up on FinViz. Let's see. WSPGF. Oh, I see right here. WSPTO. Oh, WSPOF. All right, let's check that. Let's see what comes up. And let's see, 1 year. There's no coverage of it. I'll take a quick look here. There's no analyst coverage of it, which is common when you have anything that's pink sheet. It looks like it has a Toronto listing. PE ratio 3665. Not super cheap. Let's check out the statistics. EV to revenue is reasonable. EV to EBITDA, not super cheap. It's obviously pulled back. Let's see some other metrics. Okay, positive margins, good. Return on equity, 11.2. Return on assets was a proxy of return on invested capital, 5.54. We like to see like 15. What about cash and debt? Yeah, so net debt by a significant amount, 4.5 billion. And what is their total value? 4.5 on 25. Okay. So, 18% debt. Levered cash flow 1.6 on a market cap of 22.6. So it doesn't have like a massive free cash flow yield. Nothing really like wowing me about it. I'd have to dig into it a little bit more. But let's see, profile. Let's see what they say here. Professional services consulting in the United States, Canada, United Kingdom, Sweden, Australia, and internationally. Advises, plans, designs, and manages projects for rail, transit, aviation, highways, bridges, tunnels. It sounds like almost like a Macquarie. Urban infrastructure, public and private. Interesting. I'd have to do more digging. It sounds like it's like infrastructure consulting. I'd be curious, like the types of contracts that they have and who they're getting them through. That would be my my 2 cents. What about silver? Yeah, silver is definitely between silver and gold. I think silver is the better opportunity. Silver hasn't gone up as much. It usually has like a pretty close relationship with gold, but gold has kind of like ripped and silver not to the same extent. So yeah, I think there's definitely a better opportunity in silver than in gold. Good question. Do you think an HSA is something everyone should has? It has a triple tax benefit, basically functions as a traditional IRA if it's not used for medical expenses. I'm kind of like so on it because of like the total amount. I get the value part of it. It's just the amount you can't put in as much as you could in an IRA. Like, and then if you had a SEP IRA, like if you had a business and you were putting money into it from your business, then you could pile away a ton of money. So it's 25% of the taxable income or 69,000, whichever is the lower of the two. So when you say everyone should have, I think it's a case by case basis. I think if you're married with children, yes, go the HSA route. If you're single and you're healthy, there's other vehicles that you could go through. I definitely see the value in it, but the limit is what I have a bigger issue with. I'd rather put my money somewhere else. And yes, STZ has picked up recently, and I think it will probably continue to do so. It's definitely undervalued. It just needs a few quarters. Lulu, you've probably been noticing Lulu's been picking up. They report this week, so we will be covering Lulu very soon. But yeah, STZ and Lulu have both been on a trajectory back. What do you think about gambling industry and DraftKings, litigation risk or no? Does the political administration influence your opinion on this? I think regardless of administration, everybody seems to be kind of like bullish on gambling because of the revenue that it brings in. Um, I'm personally not a huge. I don't gamble myself. DraftKings is an interesting one though. I have a buddy who runs a hedge fund and he is long DraftKings, and he said something to the effect there's like a mechanism that they have in there where like if you keep winning, they kind of like pull you down a bit, so like the exposure is not as bad. But I would say on a case by case basis, you have to like really be cognizant of it and take a deeper look at it. But also, I would say gambling typically picks up when like more people have more money, and like when there's a recession, probably not going to be doing as well. So that would be my take on it. But it seems like regardless of administration, everybody seems to be like pro gambling because of the tax revenues that will bring in. All right, friends, I just realized we've been doing this for 2 hours and 15 minutes. I have to get my beauty sleep, and really good conversation here. Appreciate it as always. Don't forget, 6 a.m. on Friday, we will be dropping a new video. So please don't forget to check it out. Obviously, pop your comments in the chat, and then I will see you same time next week, 7 p.m. Eastern Standard Time. Take care, everybody.